Hello and welcome to Amun State of Crypto Brainstorm, where we come together once a week to discuss the latest trends and analysis in the crypto world. All opinions expressed by Amun staff or guests of the podcast are solely their own opinions. This podcast is for informational purposes only and does not constitute any form of investment advice. This podcast is powered by BlockWorks Group, the only events and podcast production company I trust. For access to the premier digital asset conferences and in-depth podcast content, visit them at blockworksgroup.io. I promise you will not be disappointed.
Welcome back to Amun State of Crypto podcast. One of the biggest talking points in the tail end of 2019, and perhaps an increasingly important point of contention, is the upcoming Bitcoin Halving, where Bitcoin's block reward will halve from 12.5 BTC to 6.25 BTC. This halving will occur at block 630,000, which is estimated to be mined on the 12th of May 2020. Some have argued that, as has been the case for both the 2012 and 2016 halving events, this halving will be the impetus behind Bitcoin at a later date reaching all-time highs. But believers in even the weakest form of the efficient market hypothesis would be skeptical of this claim. In addition, there's been a lot of great research done to understand the economic implications of these halving events and consequently Bitcoin's finite supply. Today, I'm joined by Hansen and Rahul from the Amun team, and our external guest this week is Hasu, one of the best known researchers in the crypto asset industry from his blog uncommoncore.co and his work at Deribit Insights. Hasu recently published a research report titled A Model for Bitcoin Security and the Decline in Block Subsidy with James Prestwich and Brandon Curtis, which helped formalize a model for better understanding Bitcoin's economic security to understand the impact of Bitcoin's decreasing block reward. This report is a great way to better understand the implications of the upcoming halving and will be a focus of today's discussion. So without further ado, let's dive right in. Hasu, I think probably the best way to start this conversation is, before we get into Bitcoin halving and kind of the economic impacts of that, if you first kind of explain what got you into crypto, what got you into Bitcoin, and then a bit more about what you currently do within the space.
Hi, yeah, thanks for having me. I've been in the crypto space for a bit more than 2 years now. I'm very passionate about the idea of non-sovereign money because money and finance in general are spaces with huge barriers to entry that have largely been protected from disruption and free market competition for a long time. And I'm just genuinely curious what the free market can do with them. But I also see how these barriers to entry, they exist for a very good reason and they are very hard to break. So I agree with Satoshi when he says that the only way to compete with the large banks and government control over money is to create a distributed system that cannot easily be shut down. So I've been infected with this idea for over 2 years now, and my goal is just to learn as much as possible. And I found that writing about my thoughts has just helped me tremendously as a sort of feedback loop. Basically learn about something, write it down, teach it to myself, and then publish it and get feedback from other people on these ideas. And it's just a tremendous way of learning. So writing a blog was a very natural way of doing this. I later joined forces with Suzu, who runs a prop trading firm based in Singapore. So we talked every day pretty much. We share all of the same interests and have great conversations. And then we just started writing a blog post together. And Sue also went with me to Deribit Insights. So we now write the same blog that we wrote before for Deribit, which is the largest crypto options exchange.
Okay, thanks for that. I think it's especially interesting because I guess when you think about our audience and who listens to this podcast, it probably can be split into people that are very in the know about crypto, and the vast majority of them, I think, would be very familiar with your kind of work. Because as I said, you're probably one of the most well-known researchers in the space. And a lot of people on the more traditional finance side who would probably get a lot of benefit out of paying more attention to your work. So I think this is kind of like a really good segue to talk about the issue at hand, which I think, probably is one of the most important topics one could have a podcast in 2020. And so I guess the best way to start talking about the Bitcoin halving is to really set the scene for what role Bitcoin mining and the Bitcoin block reward plays in the economics of Bitcoin. So I guess, Hasu, the first question I really want to get from you, just in the simplest way possible, could you help explain why Bitcoin needs mining and what role the block reward plays in this?
Sure. So to understand why Bitcoin needs mining, we have to look at what is the system supposed to do. So Satoshi imagined a system that has certain properties, and then he designed the system using various mechanisms like cryptography and economic incentives and other cryptographic primitives, basically to create these properties. Bitcoin's ledger is supposed to answer the question of who owns what when in a permissionless and censorship-resistant way. And as alluded to earlier, the who owns what part of that question is pretty much solved with asymmetric key cryptography, because any coin is controlled by a private key, and only the owner of that private key can spend the coin, and anyone else in the network can basically easily verify that that this is correct, that when a coin has been spent, that the private key was used for that. But the second part, the when, this is extremely difficult and has not been done before Bitcoin in a distributed way. Why is that the case? Establishing an order of transactions is necessary if you want to prevent people from spending the same coin multiple times, right? This is called double spending. You can easily do this on a central server, but Satoshi wanted to avoid that, right? And I have a quote prepared. Satoshi said, "Governments are good at cutting off the heads of a centrally controlled network like Napster, but pure peer-to-peer networks like Nutella and Tor seem to be holding their own." So that tells us a lot about his thought process. He wanted a distributed way to do timestamping, pretty much. And your intuition would say, when you have two transactions floating around in a network and you're a node in that network, you just use the first transaction that you see as valid and the second one as invalid. You just ignore it. But the problem is, in a distributed system, there is no such thing as a globally consistent first. What one node sees first, another node might see second, and there's just no way for them to come to any consensus about which actually came first. So we needed a mechanism to come to agreement about which of two transactions really came first. And it doesn't matter which one, as long as we all agree. And the solution that's also laid out in the Bitcoin white paper is a distributed timestamping server. In Bitcoin, nodes can vote for state updates by appending blocks with new transactions, and validity rules ensure that transactions can't be double spent in the same blockchain. That is what we already talked about. And the voting power is based on computational power, so hashing power, just computers hashing the same thing, or just publishing hashes, right? To do these kind of computations are costly, and the Bitcoin network pays them to do this. They get paid to vote in the native unit, which is Bitcoin. And this signal that they release, which transactions came first, that is followed automatically by all the other nodes in the network. So there's basically a history that has a certain number of votes behind it, votes in the form of hash power, and the other nodes just follow it. And if they previously followed an old state with less votes, then they abandon that and switch to the new one. That kind of mechanism is necessary because not all nodes are online at the same time, right? So if you download a new node and sync to the blockchain, then you must be able to basically catch up to what is what is the latest version of the blockchain. So you see everything that everyone else sees and you agree. And all of this establishes an incentive mechanism where you have basically a flow that's going in a circle. So you can imagine you have users. Users give value to a block reward, and the block reward incentivizes miners to establish a stable consensus, and the stable consensus is used and valued by the users, and that's why they pay for it. So you have this very organic flow there. And why is it a problem if the block reward decreases? So miners cannot just do good things. They can't just make a stable consensus. They can also make an unstable consensus. So they can do bad stuff. And anyone can be a miner. So the logical conclusion from that is anyone can do bad stuff in Bitcoin if they want to. The only way to prevent this is to incentivize the majority of hash rate to be honest.
Okay, that was quite a detailed explanation, good explanation, but detailed explanation of how Bitcoin works overall. I want to jump in here. Actually, I see it always from two perspectives, right? I see it from the perspective of the miners, which you have addressed a bit, and we can go into it, right afterwards. But I would like to start with the perspective of our audience, the everyday guy on the street. If you go on Twitter, LinkedIn, all the social media, the big debate here right now is what's going to happen to the price of Bitcoin as a result of the halving. And I've looked at several predictions out there. Many of them say it will go up. The most prominent graph that I see is, the one where it shows halvings in 2016, 2012. And the price of Bitcoin went up in the I think 6 to 12 months afterwards. Do you, Hasu, or actually Rahul or Lanre, think that will happen as well this time again? So let's start this off by talking about the perspective of the everyday normal person who cares mainly about the Bitcoin price. Then we go over to the interesting part, the miners.
To chime in here, I think one of the interesting things to note that's different about this time than all of the previous halvings that sort of subsequently led to bull runs in Bitcoin is that this time there's a pretty robust market of derivatives, particularly ways for people to take a short position on Bitcoin. And if you look at the volume of the derivatives market, it's at an all-time high. It's roughly 2 to 2.5x the volume of the spot market. And I could easily see that sort of acting as sort of downward pressure on the Bitcoin price. Whereas in previous bull runs, the scarcity was a signal that price may rise. I think this time around things may be different because there's just more liquidity in the market.
Yeah, I think that those are good points. So my general stance on the topic is it's probably like none of us probably, so we all probably believe in some version of the efficient market hypothesis in general, but none of us believe all that strongly in it. Otherwise, we wouldn't be spending so much time in the crypto space if we didn't think it was tremendously undervalued. And I do think that that the halving can have an impact on the price. But maybe not in the way that it causes a supply reduction. I think it's just if we look at a different data point, which is a smaller crypto network, Decred. So what they thought they were very clever and would reduce a lot of volatility around hash rate by removing the halvings. So they have the same supply schedule, but the supply decreases gradually. Instead of abruptly in the case of Bitcoin. And as a result of that, this project, although it's technically and community-wise, it's a very, very good, serious project. They are struggling to attract any kind of investment because they just lack this marketing event that is the halving in Bitcoin and on other chains. So I mainly see it as that. It's something that drives the news cycle, and it's just a tremendous thing to talk about, and attracts a lot of people into the space and gives people something to talk about.
Okay, but based on what the two of you just said, both of you, it sounds to me like you're saying that the price increase, the previous two price increases after the last two halvings, are not mainly attributed to the supply reduction part of the halving. Yeah? Is that what you guys are saying?
Well, it's hard to say, right? So it could be due to the marketing that is the result of the halving, or it could be due to the supply. Or it could just be completely independent of that. A lot of things are happening in the macro economy as well. I would see Bitcoin in a almost perfect storm of like macroeconomic conditions that all make it a great investment at this time. And any of that could be the reason for previous supply increases.
Yeah, and I think I can kind of add to this as well. So one problem I've had, especially whenever I've seen a graph which kind of plots the 2012 and 2016 halvings and then says, okay, yeah, Bitcoin's price increased about 1 year after 2012 and 1 year after 2016. Therefore, the same is going to happen in 2020. Is that it pretty much ignores all the different factors which, influenced the Bitcoin market at those two events. And, I think kind of getting back into at least the mining side of the equation, because I think this is quite a good point to kind of segue to talk a bit more about the paper that Hasu wrote, is that, so one thing that I've always thought that, like, at the end of the day, miners mine and have committed capital to Bitcoin because of the expectation of profit. And I can imagine that something like one thing that maybe people haven't talked about a lot is that the Bitcoin halving probably could lead to some kind of consolidation in the kinds of miners that mine and the diversity in mining, because, especially given the Bitcoin price has stayed relatively hasn't or isn't very likely to reach the same highs it did in late 2017, at least in the short term. I guess this halving, at least in the face of it, would just make it very much harder for miners that perhaps exist on the margins of profitability to maintain that going forward. And I think it's very interesting to think about, okay, based off that assumption that we know that miners will make less money post-halving, what impact will that have on Bitcoin's economics as a whole? Because, I mean, it's quite interesting to think about this in the context of just yesterday or a few days ago, it was announced that some miners are coming together to try to take 12.5% of Bitcoin Cash's block reward to use for a dev fund, which, isn't possible in a scenario in which, or that kind of coordination isn't possible in a scenario in which mining is extremely decentralized and there aren't quite large cartels. So I guess there are the arguments that if you think about the kind of the second order impacts of something like the Bitcoin halving, especially when you consider what effect it could have on miners' abilities to, like, as Hasu said in the paper, kind of miners' expected revenues from these kind of things, maybe the situation doesn't look as nice or as positive as if we were to just ignore all those factors and focus simply on what the Bitcoin price did around those two events.
Yeah, I mean, I totally agree with you, Lanre. I'll let you jump in a second, Hasu. Basically, it's like, imagine the four of us have a business. We sell a certain good, apples, for $2 per apple. And starting from May 20th or block 610,000, the price is going to cut in half. I mean, it certainly will have an impact on miners. Most likely will make mining unprofitable for those who don't have optimized or like really efficient equipment, right? And, the other input is electricity. So only the ones that have very cheap electricity, very optimized equipment to mine, are going to be competitive. I think, it might drive out lots of small miners.
In general, we should absolutely expect if the pool of SHA-256 block rewards halves, then we should expect a significant portion of miners to well go out of business, right? Maybe not immediately, but definitely over the longer term. And the reason for that is that where you can see mining as a sort of dollar auction, right? So if $1 is auctioned between miners in an efficient market, which mining definitely is an efficient market, then you can expect the miners to expend up to $1 to earn this reward of $1, right? Maybe they spend like 99 cents, right? If they would spend more, then some people would just stop bidding, and if they spend less, then more people would start to bid. So we know that there's always an equilibrium between like the reward and the hash rate.
Do you guys think that, miners earn the block reward, but they also earn a transaction fee? I'm not sure how much of the total money they get is a transaction fee. I think very little. But do you guys think there will be a spike in transaction fees to somewhat offset the missing 6.5 Bitcoins you get per block?
I think that would be really unlikely. So, by the way, transaction fees are around 2% of the block subsidy right now, or 2% of the overall block reward right now. So they would have to jump by a lot to make up for that. But mainly, I think that's very unlikely because there's just no mechanism to incentivize that kind of race. So people pay transaction fees to basically pay for priority when the market for block space is crowded. So then you want a bit more than the other people to get in, and they don't get in, right? And this has really nothing to do with how much security Bitcoin needs. How much security Bitcoin needs and how much money miners need to make is not present in that equation. It's just how much is priority in the block space market worth to me right now? And the answer right now is it's worth nothing, because blocks are never full and haven't been full for like 1.5 years. And there are basically almost no fees at all. And I think it's unlikely that's going to change, because you can see security, or like the kind of like stable consensus that we talked about as a common good. Everyone wants it, everyone benefits from it, but nobody wants to pay for it. And it's always better for you as an individual if others pay for it and you just consume it. And the reason for that is there's just no way to exclude someone from using it, other than if the blocks are actually crowded and you don't get in, then you pay for priority. But you don't pay to create that good. You just pay to get in, and there's just a very big disconnect. And it's not really clear how the incentives of all that will shape out.
Yeah, and I think that brings up quite an interesting point. So, like, often, at least I've done this, and I guess a lot of the discourse in the space around this particular issue has done that, of conflating kind of the role of the block reward, as you've said, to ensure the well ordering of Bitcoin's blockchain going forward, and the role of the transaction fee for allocating block space efficiently. And obviously those are quite different concerns and should be treated quite differently. It's quite interesting because even looking back at, I don't know if you mentioned it in your research paper or another, but even Satoshi kind of conflates the two, or not explicitly, but kind of implicitly, in the fact that he kind of hand waves the issue of the decline in block subsidy and the effect it will have on economics by saying that in the long term, transaction fees can replace block rewards, and doesn't really address the issue, much further from that. And I guess at this point, since there's so many things we can talk about in regards to what effect a decline in block subsidy can have, maybe this is a good point to kind of start talking a bit more about your paper in particular. Because in the way that I see it, you can kind of separate the paper into two halves. So the first half kind of formalizes the economic incentives which ensure that Bitcoin works the way it does. And the second half kind of talks about some of the issues associated with the decline in block subsidy. So it would be quite interesting, Hasu, if you could, in the simplest way possible, describe the first half first and explain how Bitcoin's economic incentives work to ensure that Bitcoin works. And then we can start talking a bit more about the decline in block subsidy and what some of the solutions to that problem could be?
Sure. So yeah, we already covered part of the first half. The first half is pretty much how Bitcoin works, what are the goals of Bitcoin, and what are the mechanisms to reach these goals. And so we already established why Bitcoin needs miners, but we didn't really cover so far why are we actually concerned that if we don't pay miners enough, that something bad will happen. So we give miners this ability to state the change the state of the blockchain, and they can really do two things with that. They can rewrite the chain, for example, to make double spends, or just to undermine the stability of consensus with frequent reorganizations of the blockchain, frequent rewrites. Or they could just stop writing the chain altogether, which would be a form of censorship or denial of service. And they can do this either for like groups of people or groups of transactions, or even for the network as a whole. And we have to ask, miners have to ask themselves, they have this hash power, and they can either point it at the tip of the chain and mine in like the way that the users want. They just process transactions based on who pays the most fees, and they always mine on the tip of the chain. Or they can use their hash power to do something else. Maybe they make double spends, or maybe they take a large financial bet against Bitcoin, the value of Bitcoin, and then they just make a complete denial of service of the network. Nobody can get any more transactions in. So that's also possible, right? And that would certainly undermine public trust in Bitcoin. And if the block reward, which is basically how much Bitcoin spends to secure itself, or how much users spend to secure the network, if that gets really small compared to the network value, which is basically how much Bitcoin as a network is worth to users, then we could get into trouble, in my opinion.
Actually, I have 2 points here to add. The first one is, I mean, now we established the transaction fee paid is a minuscule amount of the money that miners earn. So if we extrapolate from the upcoming halving to the last block ever, when like there's no reward anymore, what's the incentive then for miners to do something? Mm-hmm. That's my first question. And the second question would be, do you guys think that Bitcoin now is, the miners, let's say only the efficient miners stay there, the big miners, probably there's more centralization there, or definitely actually. So the likelihood of attacks is going to increase as a result of the decrease in centralization?
I would maybe answer the second question first, because I think it's a common misconception that Bitcoin basically assumes an honest majority at all times, or that Bitcoin is somehow in trouble even if one guy controlled all the hash rate. And I personally think that assumption is not needed. And even Satoshi is misunderstood. So Satoshi didn't believe Bitcoin needs an honest majority, or that we have to assume that for the system to be secure. He only assumed that miners act rationally, meaning they maximize their own self-interest. And he wrote in the white paper, the incentive being the block reward, right? The incentive may help encourage nodes to stay honest. If a greedy attacker is able to assemble more CPU power than all the honest nodes, he would have to choose between using it to defraud people by stealing back his payments, or using it to generate new coins. He ought to find it more profitable to play by the rules, such rules that favor him with more new coins than everyone else combined, than to undermine the system and the validity of his own wealth. I think that very clearly illustrates this decisions that miners have between mining honestly or mining to basically disrupt the network in any way. And we need to make sure Nakamoto consensus makes sure that it encourages the majority to be honest. It doesn't assume the majority to be honest. And there's a very big difference there. And if we know that we need to encourage the majority to be honest, then the logical conclusion is that how much money we pay we pay for that incentive, or the size of that incentive needs to be in some form symmetrical to what we want to protect.
Yeah, actually, that's a really good point. True, right? I mean, if the costs of any of the attacks that you outlined is probably too high for someone who's just optimizing for his own, maximizing their own utility. What about the first question, though? Now we are in the year 2140. Everyone is driving electric cars. Now a miner receives, only the transaction fees for solving a block. How do you see that playing out?
So I would first say that this is going to be a problem a lot sooner than 2140. So the block reward will halve to 1.9% this year, and to 0.9% in 2024, and to 0.4% of network value in only 2028, right? So then we are already way lower than we are right now. And I think in 16 years, we have issued 99.9% of all rewards. So I would put that as a disclaimer. So this will matter sooner than in 120 years from now. And apart from that, it's a good point. So first, I would say that transaction fees can absolutely pay for the incentive for miners, and that's all good. So if the transaction fees are high enough, then I think the system works fine, just like it does today. I think you're alluding to a paper that's called "On the Instability of Bitcoin Without the Block Reward," which looks at Bitcoin basically in a transaction fee only paradigm, and it raises it draws up an interesting scenario where basically transaction fees are very volatile. So at some point there's a very large transaction, or there's a burst of demand to fill blocks, leading to large transaction fees. And then imagine that one miner just takes all these transactions and puts them in a block and publishes that block. And now you're the next miner whose turn it is to make a block, but there are no more transactions. So what do? You can either make a block and add it to the blockchain, but it doesn't pay you anything because there's no transaction fees. Or you could basically reorganize the block of the previous miner and take his transaction fees, right? What they conclude is that there might be some volatility around the tip of the blockchain where miners fight for transaction fees. But that's not really a concern, in my opinion, just because if a miner knows that the next miner will reorganize his block, then he can just take only some of the transaction fees and leave some, like the other half or more, to the miners that come after it, to incentivize them to build on his block, right? So I think the big concern is that transaction fees won't be high enough. But other than that, I think the incentives of that look fine.
That's very interesting. I mean, on that note of talking about transaction fees not being high enough to sort of make this cost effective for miners to continue mining in an honest manner. One of the things that one of the sort of possibilities is that with the changing unit economics of the mining business, we'll end up in a situation where those miners with a certain economies of scale and with a bunch of capital on hand and people who didn't over lever themselves during bull runs to buy a ton of equipment or hire a ton of engineers or something, those miners whose unit economics are sound in this sort of new halved landscape, those miners will consolidate and they'll be able to collude. I'm curious what the group's thoughts are on the possibility of increasing centralization of miners and their abilities to collude with one another, as opposed to sort of the case which you had brought up earlier, where they sort of, they reorganize the previous miner's block, which is really scalping off of someone else, another miner. What if they were to just collude to take almost a fixed transaction fee per block? Do you guys think that's possible?
So yeah, you're touching on a solution to this problem, right? That transaction fees might not be high enough, at least in the eyes of the miners. And this also goes back to what we discussed earlier, that the block reward and the basically the incentive that pays for stable consensus is a common good, and common goods are by definition non-excludable, and that's why they are common goods, because anyone can use them, and there's no way to exclude anyone from using it. You're absolutely right that a majority of hash power could make block space excludable basically by taking a minimum fee. That's definitely possible. Yeah,
it's interesting because the sort of catch-22 of that scenario is you get this hyper, I wouldn't say efficient, but rather a very convenient fee market, at least very understandable from a retailer's perspective. But then you also get, as a trade-off, you have this increasing centralization of Bitcoin. And then at that point, what does Bitcoin even really mean? Is it no different than a centralized fiat currency?
I would also add to that it's absolutely not clear that such a scenario would be stable among miners, right? So one thing to note is that if the majority of hash power forms a stable cartel, then yes, they can put a lot of rules into place, especially regarding other miners, because they could just. And we see this right now with Bitcoin Cash, actually. I would encourage you to check out an article that I just published today on this developer text that was established in Bitcoin Cash. This is basically a miner-activated soft fork. And it means that, basically they make the rules stricter. So some transactions or some blocks that were previously valid are now invalid. But it's backward compatible with old nodes. In this case, miners could make such changes like over the heads of the users, in a sense, by just threatening to just ignore all blocks made by the minority, the hash rate minority, and they can do that because being the majority, they know that their chain will always grow faster in the long run. And even if the minority gets 1, 2, 3, 4, 5 blocks in a row on the blockchain, we know that statistically speaking, the majority will overtake them at some point, and then all the minorities' blocks will be reorganized and will be orphaned. But it's not clear that a majority of 51% is stable at all, because let's say you have the same tragedy of the commons among miners pretty much. So why should you take part in that cartel when you could refuse? So the rule would be we don't include any transactions below $100, right? But now there's a transaction in there that's $90. So why should you stick to the cartel and not break the rule and include the $90 transaction?
That's quite fascinating. I think the analogy of kind of this majority miner group kind of censoring a minority miner group is very similar, in my head at least, to the analogy of kind of a casino in its house against a gambler. In the long run, the odds are always in the house's favor, but then you bring up this interesting point where why does this majority group continue to collude with each other? Why don't they cheat? I mean, just sort of with no mathematical or economic grounding necessarily, I just would imagine that in the long run, it seems like colluding with each other and continuing to maintain stability would maximize their profits. Do you not think that would be the case, or do you think it would manifest itself differently? Like the benefit from cheating would outweigh the benefit from being in this kind of harmonious collusion?
I think that's basically classic prisoner's dilemma, where yes, basically the collective payoff for everyone would be higher if they cooperated, but it's for any individual miner, the incentive to cheat is just larger in the short term. So yeah, I don't think it would be stable.
Right, and sort of on top of that, it's unclear among this majority group of miners. Maybe there's one entity that is a majority among the majority, and sort of the incentives of each of these entities might not be as clear cut as like the models might suggest.
And I would also add that so a mistake that many people make when they think about the economics of Bitcoin and miners, they always see that the miners as a basically coherent group that's kind of closed off from the rest of the economy, and that's really a big mistake in my opinion, because as we said, anyone can be a miner, right? So that's the innovation in Bitcoin, that anyone can participate in this, and that's where it gets its censorship resistant and its permissionless access. Because if users are basically want to pay more for someone who makes better updates, then they can pay more, right? Just this what the transaction fees kind of put in question is, what is the mechanism for users to coordinate, to fund this kind of system?
Yeah, definitely. I see exactly where you're coming from. It is a interesting dynamic, and to black box crypto from the rest of the economic world is just too much of a mistake, because this is all money at the end of the day to these mining businesses. I mean, on that note, I'm sort of curious. I mean, we're all here because at some level we believe this technology will work. Or at least, we hope we can make some money off of it. But then I guess, Hasu, from your perspective, like, what is the solution to this, or what are some of the solutions to this dilemma of, sort of continual halvening and sort of transaction fees? Like, where do you see the like, do you see a mining market coming to an efficient solution to this, and how would that play out?
So I don't think the mining market can solve this, because as we said, it's a prisoner's dilemma, right? So miners are always better off maximizing their own short-term revenue than cooperating with everyone else in the long term. And it's also not clear that there's like an easy solution from the user side. The goal of our paper was to map out the solution space. How do you even think about coming up with a solution? And so we have we have 4 ways of thinking about this, 4 directions how we can attack the problem. And the first would be to increase demand for block space. So we keep the current funding mechanism with just the priority market for block space, but we increase demand for block space. How do we do that? So a very easy example would be the Lightning Network. The Lightning Network is a layer 2 solution for Bitcoin, and it adds a whole new way of using Bitcoin, like a whole new set of properties that you can get out of Bitcoin. It's immediate transactions. It's more private, right? So that would be like the big advantages. And it's also very trustless, same as the Bitcoin base there. So it doesn't make very strong trade-offs. And that's something that we would expect would drive demand for more base layer transactions, because the Lightning Network needs a certain footprint on the Bitcoin base layer. And you can imagine not just the Lightning Network, but you can imagine several other solutions like that, several other layers on top of Bitcoin that expand basically the space of things that people can do with Bitcoin, and thus that ultimately create more on-chain transactions as well. We can also add more or allow more asset types on Bitcoin. For example, so Tether was on Bitcoin, right, for the longest time. It's now no longer in Bitcoin, and personally, I don't think it's very likely, because just Bitcoin is not really optimized for other assets. We can incentivize or make it easy for other networks, other companies, and so on, basically to use Bitcoin as a security anchor for their hash data. We can make better smart contract functionality to enable, let's say, covenants or better multi-signature, all that kind of stuff. Just make Bitcoin transactions more useful to drive more demand. That would be the first one. And we can also tackle basically the priority market from the other side, which is, let's lower at the same time the supply of block space, right? Because the transaction fees this is the point where demand and supply meet. So we can either increase demand, or we can lower supply, or we can do both. And block space we can lower either manually, or we can also do it automatically, but in a non-discretionary way, by introducing something that we call adaptive or elastic block size. In this proposal, the block size would adjust downward. It could not adjust upward beyond the current cap for block space, because there are very good technical reasons for that limit to be in place. But it could adjust downward, so there's never any excess space, right? It would look at how many fees were paid in the last, let's say, 100 blocks or the last 5 blocks, and then it would adjust downward to remove excess block space and thereby create fee pressure. Those would be the first two. Are there any questions about those?
So no questions off the top of my head, but it's quite. I do think it's quite interesting when you talk about an elastic sort of block size. Sort of what you're implying is miners are, sort of baked into the protocol almost. There's like a moving average of how many transactions have filled the last 100 blocks, and they're using that to determine the size of the next incremental block. I mean, do you think that something like this at a protocol level would be feasible within the Bitcoin network? Do you think this is something that could get passed?
Oh yeah, I personally think it's very likely that we will get this, just because it's a solution that only applies in some cases, but in the times or in the situations where it doesn't apply, it doesn't do anything bad. So it's kind of a free roll for the network to adopt this. There's just at least as far as I know, there are no negatives to this. It's better sometimes, but never worse, because pretty much everyone agrees, and everyone I talked to from the developer community agrees that Bitcoin needs the incentive. It needs a sufficiently high block reward to be secure. And this is kind of a backup solution for times where the fees are not high enough. So we can at least drive them a bit higher, even if this is not our only solution.
If a certain consensus can be achieved by the stakeholders, I could definitely see something like an elastic block size taking shape as well. I mean, the initial point that you brought up of sort of almost having multiple layers to incentivize more base layer transaction volume and sort of a smart contract system, that almost seems leaning more on the Ethereum end of the spectrum. And I wonder, just almost at an ideological level, if the Bitcoin community could ever get to the point where they'd be willing to succumb and say, yeah, we're in fact building something much like Ethereum. What are your thoughts on sort of Bitcoin eventually becoming something like Ethereum in the event that there isn't an elastic block size implementation?
I think there's basically there's no connection between the elastic block size and Ethereum. So you can bid this on Bitcoin today. It's no problem. You don't need any more smart contract functionality for that. The big difference between Bitcoin and Ethereum when it comes to smart contracts is Ethereum is stateful, so it has a global state, and Bitcoin in Bitcoin state only exists locally. So Bitcoin is stateless. It has basically a very simple scripting functionality, right? And I don't think that is ever going to change, or that should change. So I don't think there's any connection to the elastic block size, and I don't think that Bitcoin will ever be stateful in terms of its smart contract functionality. So there are a lot of ways you can make Bitcoin smart contracts more useful. Without making them stateful, in my opinion. So governance, for example, would be something that almost every developer wants. Then you have basically you need some changes for L2. L2 is a new form of payment channel that could make the Lightning Network much better. That's something that's very likely to make it into Bitcoin at some point, in my opinion. I just think that there are some things we can do to make Bitcoin smart contract functionality better without making it anything like Ethereum.
Just to jump off what you just mentioned, Hasu, I actually think that was a good point that I didn't initially consider, but statefulness, I guess, is one of the crucial components of Ethereum, and if Bitcoin can successfully manage to sort of build smart contract and a smart contract system and multiple layers, layer 2 solutions, sort of whatever number of layers you want to go beyond that, then it would still be sufficiently different than Ethereum, sort of avoiding the whole debate of whether Bitcoin is morphing into Ethereum or Ethereum is morphing into Bitcoin.
Oh yeah, I would just add, maybe that's not something that all of your listeners know, but every coin in Bitcoin is also wrapped in a smart contract. So Bitcoin does have smart contract functionality. It's just not stateful as Ethereum is. But you can define all kinds of spending conditions for Bitcoins as well, like multi-signature, like time lock, and stuff like that.
Maybe on a light note, a fun question, personal question for me. A room in my apartment is free now. I don't pay electricity. In light of the halving that's coming up, Hasu, do you think it's still worth it for me to get some mining equipment and mine Bitcoins?
When your electricity is free and you think you can get away with that, then sure.
No, awesome. Okay, it was awesome, to speak with you guys. Very interesting topic. Special thanks to you, Hasu, as our special guest. We look forward, maybe in the coming weeks after the actual halving happens, we could sit together again to see, if the things that we said actually happen or not. But thank you everyone for joining, and we look forward to seeing you next time.
This was it from the Amun team. Thanks for listening, and if you have any questions or would like to see your topic on our next episode, reach out to us on Twitter or LinkedIn. We'll see you next week.